Hey guys, thanks a lot for coming. We've got a really good turnout. I got some really good feedback last time. And so once again, we're just going to go over some Bitcoin analysis and also some altcoin strategies. And of course, we're going to go over the charts. But first of all, I'm just going to recap over things we talked about last time. So last time, just to quickly recap, as a group, we all kind of agreed that we were in the early adopters to the early majority stage in crypto. The people who were the innovators are people who got involved in crypto, I'd say between 2012 to 2013, 2014. Those people have become multimillionaires and in some cases billionaires as well. But even though some might be billionaires, the people that got involved in crypto between 2012 to 2013, those people actually took the most risk because at that time, there was no actual proof of work and the technology was very new. But because of the calculated risk at a very early stage, they were handsomely rewarded. We kind of agreed as a group also that we're not exactly in the late majority yet because there's still a lot to work out. First of all, a lot of things need to be settled. For example, stablecoin regulation, as we know with the Terra Luna crisis. I actually shorted Luna from 52 to 2, but that's another story. We're kind of in this early adopter to early majority stage, in the sense that, whilst institutions have got in, there's still a lot more things to figure out, right? And you can argue that people who are involved currently right now, so the more early adopters, early majority, you can argue that whilst the reward might be a lot less for us, we're actually taking significantly less risk than the innovators, because now there's a bit more proof of actual technology working, right? There's a bit more proof and there's a bit more obvious use case. One of the things that fascinate about crypto is just the transparency, really. How do we really know what banks are doing? Because we're only really getting the information that they're telling us. The market cap of Bitcoin currently, I believe, is around 300 million. The market cap of gold is 9 trillion. So that is a potential 30x, right? And I'm in the Generation Z. So our generation is called Generation Rent, in the sense that the vast majority of us will not own a house. And so for me, crypto is just the only hope, really. It's that kind of hope against inflation. Ultimately, I believe that the government has just screwed us over. And I see, hopefully, that crypto will have more transparency. And I just like the way that transactions can all be recorded. And it will just be really cool to audit money flow and just see how just these big players and governments and what they're actually doing with the money and if they're doing what they actually say they are. Last week we also talked about risk management as well. I'm just going to talk a little bit about that before we go to the charts. And for me, it's the most important thing about trading. Most people are trying to swing for the fence, hit home runs. But I'm always thinking, how do I avoid the worst possible scenario, right? For me, trading is how do I live to fight another day? I don't expect to, make big winners overnight. Big winners I hope to get by the accumulation of good habits over a long period of time, right? Like, for example, if you went to the gym, you wouldn't get shredded from just one day or just a couple of workouts. You would expect to get shredded over a couple of years, right? By doing upper body, lower body, full body, leg day, all those things. Consistent habits over a long period of time. So I don't see why trading should be any different. And of course, it just depends. Risk management, it really depends if you're scalping or swinging. There are some differences, of course. But I generally, use a risk-reward ratio when I trade. And what that means is that, for me specifically, and this is quite common in the trading industry among professional traders, I aim for a 3-to-1 risk-reward ratio. And what I mean by that is that every time if I risk 1% of my portfolio, I expect to make 3 units of reward, so 3%, right? And so that way that if I'm making 3 times the amount as I'm losing, that means that my win rate only needs to be 30%, right? So if I win 1 out of 4 trades, then if I have a 25% win rate, then I can break even, right? So if you can play along with those numbers. But and just find out what works for you. You don't have to stick to 1 to 3. Some people stick to 1 to 2. Some people aim to make 2 times as much as the amount they're risking. So I only risk 1% per trade. So 1% of my overall portfolio per trade. But of course, some people, I was always taught that way. Some people might risk 2 or 3%. And what I would say is that it just really depends on you. But you should always think, how do I live to fight another day, right? And you might be the best trader in the world, but if you're risking 10% of your account, 10% of your account on every trade, that means that after 10 attempts, you're going to blow up your account, right? So you need to be able to survive long enough for your strategy to kind of catch up with your losses, right? To compensate for losses, right? For example, if you've got $1,000 account, you might, some people, I only risk 1%, sometimes max 2, but rarely. If you risk, some people might feel if they've got a smaller account, they want to risk a bit more, maybe 3%, right? It's personal discretion, but the whole idea is that don't swing for the fence, and this is a really risky environment, really. There's so much, and in bear markets, a lot is driven by news and just this, for example, the Federal Reserve. There's a lot of things that can go wrong, right, in a bear market, right? So that has to be considered. That's the most important thing.
This is amazing. Make it all back. The importance of risk management. I got a screenshot of that. That's cool.
I mean, some people scalp, some people swing trade, but I generally tend to go for 1 to 3 or 1 to 4, sometimes 1 to 5.
Yeah.
And it's just like the idea of, it's just consciousness, because it's just that I treat this like a business. So for me, the max pain was so in 2017, I converted 5K into 300K. Then I lost 300K. Then I realized I was just a complete idiot. I had no strategy, and it was good, but it just wasn't fluid. Yeah. And that was when you blow up your account, you feel max pain, and you kind of have a rite of passage in some sense that you felt max pain, so you know what happens when you bend the rules, right?
No, sure.
And the thing is that it's often advice is arbitrary until you actually go through it. But like, my goodness, when I lost it, I was so pissed, and I just would love to help speed other people's learning curve, really. But
that's the whole premise of this whole thing, man. That is the whole thing. Like, it's kind of an interesting question or like idea you bring up there. It's like you need to go through max pain so you know what it is, so you don't go back there again. Learn from your experiences, and that's kind of like you can help people and traders, right? And you can give them a lot of insight and give them experience, like ideas, and you can kind of give them your knowledge. But unfortunately, it will help and it will stop you from making the big losses or losing everything and then not even being able to trade and have to go get a job or something, right? That's what you're really going to stop. But a lot of the time, like, even if you help someone a lot, you tell them all these things and you give them all this knowledge, it is down to them, and a lot of the time they will end up doing the similar thing they would have done anyway, but just maybe slightly less painful, but still eventually will be good for them, because then at least they know that, because it's really difficult to be really successful without seeing that pain, because the pain is what stops you from doing it again, like the feeling and the fucking, like, shit, what did I do wrong, how did I do it wrong, you go down all the little routes, and you think about yourself. It almost breaks your own, in some respects it can break your own mentality. It can like break you as a person. Like, I found times where I've been sitting there pulling my hair out, like, why won't the number go up? Like, I look at the screen, I'm looking at a number, I'm like, I cannot get the number to go up right now. It just can't, and it's just so frustrating, and it can really break you. But at the end of the day, all those things were good. So it's an interesting thing you bring up there. It's like you have to feel the pain to enjoy the good winning streaks, and the more pain you feel, eventually when you become profitable, then the less. Then you will be like, fuck that shit, I'm not going back there. So, yeah, it's an interesting one, man.
Like, risk management is not sexy. Like, no one gives a shit about it, to be honest, until they need to, right? If your win rate is 50% and you're going for 1 to 3, that means you can make millions over the years, or thousands, if you just stick to that. It's not just about risk reward. It's also about win rate as well. For example, you can have a good win rate. So, for example, you might be winning 100% of your trades. But if you're risking $20 a trade to make $5, then over the long run, you're going to just screw yourself over, right? Because if you think about it, over the periods of 10,000 trades, you're not going to be a profitable business, right?
Yeah. No, I understand what you mean. It's a lot of people look on paper and see, oh, this guy only wins 3 trades out of 10, or he only wins 10 trades out of 100, and you're like, yeah, that doesn't really mean everything, because you need to work out how much profit you made from those 10 wins. And that could you could lose, like, similar. I said it a second ago, the Turtles, they lost 15 trades in a row, but they got one right and they made like hundreds of millions. So like, we're talking risking $1 million on each and then make $100 million on the last. People, I understand what you're saying, because I see this all the time. Like, especially when people look at even the MDX Algo trading bot at the moment, it's only winning about 50-50 trades. But back-tested, if you look at it, when it does take a successful trade, it's going to run the swing trading algorithm. So it's gonna run with that swing. So you can get chopped up in the range like we are now. But as soon as we do get a break either direction, it is a long bot. But obviously, if you sell and you buy back later at a lower price, it's a short in essence. But that's what I think you bring up a good point here. Like, most people don't realize that. They think, oh no, well, if he doesn't win 6 trades out of 10, he's a loser. That's not true. That's completely not what you're looking at. Because you've got to look at what you just said. You've got to look at what is the risk to reward he's doing on each trade, and how much profit are they making on each trade they win. So I think it's another good point you're bringing up here, mate. To be honest, this is good education for people, because a lot of people don't look at that. We get people sometimes message like, "Oh, the trading bot it's not doing very well." I'm like, "Well, actually, it's a swing trading bot and it's doing 50-50 at the moment. So like, when it hits a win, it's going to be a big win." So
this is just something else we brought up last week. I mean, but generally in bear markets, the ultimate goal I find is you're buying the dip to sell the rip, right? Like, you're not trying to get married to altcoins until there's a macro reversal. So this kind of long diagonal diagonal trend line is, once that kind of breaches and we get past that, that's when I kind of go more heavy on altcoins. Obviously, you can't really time the bottom, but that's when I'm kind of shifting from that. And the MDX algo is great as well, because if you go in the weekly, it shows, like, what I love is that in the MDX algo is that if you go in the weekly, you put the MDX3, it kind of gives you a general narrative. Okay, so in the weekly, it's kind of red. Okay, so it's a bear market. Okay, so I'm not getting married. Okay, this is an analogy, but I'm treating my altcoins like a one-night stand rather than a marriage. And it's kind of crude.
Yeah, nice.
It's crude, but so
you're fading into the pumps because the overarching weekly is down, and we actually have this is one of the things we're actually putting into the next update, where you can have multiple trends on one time frame. So what you could do is you could have the weekly overlapping the hourly, and you have 2 lines. And then you could see, okay, well, the way that I'm going to do another video on this actually when the next updates come out. But the indicators are perfect when what you really want to be doing is you want to see what the overall long-term trend is, and then basically trade the same direction on shorter time frames. So say, the weekly's down. We got a big downtrend on the weekly, and you can see the trending line coming over. What you really want to be doing is on the hourly, when you have a pump, and you get an exhaustion, and you get a short signal, take the shorts within the longer-term trend, because they are going to be higher probability, because obviously the trend is your friend. It's going to be going in that similar direction if you're a swing guy. So what you really want to be doing is you want to be looking at that longer-term narrative, the daily, say. Daily's downtrending, then you're on the 5-minute. What you really want to be doing is you want to actually just be selling into the fades of that daily trend, and then selling, the 5-minute, the hourly, the 4-hour down, and selling into those. So it's actually an interesting chart you've got here, because, look, Bitcoin is fucked around with, because it's such a retail-based trading environment, especially on these exchanges, derivative exchanges. There are big players, but most of them are over the desk, so OTC. So like this descending triangle, I did a video about it a second ago. I am going against it now. It's too obvious, and like sometimes when it's too obvious in crypto, it goes the opposite way. There's actually a chart I've still got on one of my TradingView accounts, and if you go back to when Bitcoin first dropped to $30,000 from 60.
That's what I was saying. Everyone thought this was a descending triangle, but I was going heavy.
Yeah, exactly. Yeah.
Everyone
thought it was a descending triangle. It actually broke to the upside, and then if you go to the next dump from 69k, if you go to the right on your screen, you can see this one here. When it went from 69 to 30 again, you can actually see that could look like, if you go up a little bit, that looks like an ascending triangle. A lot of people there were saying that's an ascending triangle. So you have a flat top, and then you have the highs getting, the lows getting higher towards the top. You have the deviation at the very, very end, where it came up, it broke the top of the resistance, it broke out, The whole world went long, and then it flipped, and then it dumped all the way back down to like fucking where we are now, 20. But that actually, a lot of people were interpreting that as an ascending triangle. So what happens is, when everyone starts seeing the same thing, the market goes the opposite way, and that's not just because it's not because it's completely manipulated, it's because of the order books, because the order books are more people long, and that's going to create a situation where there's a domino effect, because everyone thinks that it's the market makers, it's the market movers, it's completely manipulated by exchanges, yes, to a degree, but they can't change the overarching long-term movement of a market. What happens is the order books get so on one side, like long or short, the funding goes crazy, and then it only takes let's say if the market's 80% long, the more and more long you get towards 100%, it means the exponentially less amount of money you need to sell to start the fire. And the fire is those longs getting stopped out and liquidated, and then that's forced sells. And that's why you see Bitcoin so volatile, because it's not because everyone's like, it's a new asset, it's volatile. Well, yeah, but it's also because every single order, basically, or every single position, apart from big players buying it and putting it on a cold storage wallet, is a derivative of Bitcoin, which is 1-to-1 in an exchange where there's no real margin. So like every single position is actually there's no when I say real margin or real leverage, you can't like go into debt. There's no way you can go underwater on a position. If you get liquidated, that's it. In traditional exchanges, you can put up collateral. You can say, okay, I'll put my house, put my car, I'll put my fucking assets, I'll put my watch, my Rolex watch. I'll use that as collateral to back my position. And if it goes really, really low, then you lose everything, and you go into debt, and you go lower and lower and lower, and you can go negative equity. But that's why Bitcoin's so volatile, because as soon as you get licked, there's no way getting out of that. The position is literally 1-to-1, so you will always lose what you bet in an exchange in crypto, which is actually a very good thing long term, but in the short term it creates a lot of volatility, which is also good for crypto traders, obviously, and that's why everyone fucking trades crypto now, because that's where all the opportunity is.
Yeah.
You got a nice measured move on this, taking us to around 28, I think.
So what I found with trading is that the actual win rate of trading based on patterns is actually quite low, because it's so it's so subjective. See, initially everyone was thinking this is a descending triangle. I mean, statistically descending triangles, once it's 75% full, as you know, there's a higher chance of breakdown once it's 75% full, and usually there's a gap between the 75% full to the apex. So once, for example, so in simple terms, to say this is a descending triangle, once it gets to 75% full, it generally breaks down. But this has just gone on and on and on.
Yeah, I'm agreeing with you. When it goes past the apex, it invalidates it.
And the thing is that everyone and their mother is saying, oh, this is a descending triangle, it's going to break down. People are thinking back to 2018 and whatnot. And the thing is that, like, the market, what I find, it just does not give home runs that easily. It just doesn't. Like, if it was that easy, everyone would be rich, right?
It will go against the majority. Like that is the famous quote I say in crypto: the market will make the fools out of the most, because it can't give everyone a win because of the order books. If it's a manipulated market like the gold or silver market, or say stocks, I say banks run the stock market, exchanges have a degree of control over the crypto market. But like, if everyone's fucking long, like there are times where in bull markets where everyone can be right, and that's because you've got a new range of buying participants who are coming from an external place. So like when Bitcoin goes for expansions, it's because there's new money coming in from people who aren't already in. There's not just traders fighting each other in the range. You have this new money coming in, so everyone who's trading it can be right. But when you get to these positions where it's like, okay, well, everyone's like, we're going to go down now, and the whole market goes short, very, very unlikely that we're going to go up. But with this wedge you're seeing here, like, I still do think textbook it is a descending triangle, because it is all holding up around the lows. All the wicks are coming to the same place. And also we do have more longs on the order book. So I'm not ruling out us going lower here. But I just think that looking at traditional markets, how they're postured, I think it could be interesting to see a bear market rally up to 28.
So my belief is that this whole year, from the high of 70k-ish or 69k, we've been kind of dancing along these two white parallel lines, as you can see here and here. So this was the peak, and this was again hitting support, and this bit was just a bit of a deviation play, slightly over it. And my eventual belief is that we eventually do tag, 16 to 14k, and potentially as low as 9 to 12k actually, because these are key order blocks and demand zones from 2018, 2019. But that's not to say the exact route will be simple. There's always a potential for a bear market rally to 28k or 32k, just to kind of catch as many people off guard as possible. And the market just loves to find ways to squeeze as many people as possible. And if it was that predictable, then everyone would be really wealthy. But the thing is that, of course, this is just my kind of belief and based on technical analysis. In general, I don't like to trade that much based on fundamentals and news. I will always consider that, but very often I've been more successful in trading when I've just stuck 90% of the charts. And generally the charts tell the story. That it's also, in this last couple of years, crypto has had so many garbage projects, and I kind of feel like we do need a flush out of the garbage in crypto. And if you look at the .com crash, it's only the top companies that actually survived, like Amazon. And so I'm a firm believer in many of the top 100 crypto projects and stuff. Things like Polkadot, things that have a good use case. But I just kind of feel like this kind of oversaturated. A lot of the garbage does need flushed out. But at the same time, a lot of people are bearish and calling for new lows. And, there doesn't need to be. There just absolutely does not need to be a crash down to, 9 to 14k. For all we know, 17.5k could be the bottom, right? So whilst I am macro bearish, I do believe it run up to 28k, 30k is definitely on the cards, and potentially a run back down. The exact route can just be unpredictable, really. And so for now, I'm just going to stick 90% on the charts technical analysis. Of course, I'll keep updated with the news.
We had the bear market rally in 2019, which took us to 14, so that's what I'm looking at as well. Really see the order books getting crazy long. And then, the mother, the dog, the cat, and the fucking cousin are all long. And then we see the dive down to 14 next. I can see that a pop.
Yeah. But it's just the exact route can just be twisted, right? Like, it can take a route that just squeezes maximum number of people. I think for me, 32, this kind of region here is the point where once we get through there, I think there's more of a shift into a bull market. The 32k region for the kind of macro reversal. But until we go through here, I think it's just kind of consolidation, really dancing around, really. The 32k region is like, if we can kind of like push through that, like go up and then higher, and that can kind, 32k, that could be the point which we kind of. But the thing is that markets don't just go from a bear market to a bull market. There's obviously kind of sideways bullshit and all that. It doesn't go like.
Yeah, of course.
It's so much sideways.
Yeah, exactly right. It takes time for greed to build. What's your definition in your mind of what you would say a bull market is in relation to what a bear market is?
A bull market is basically you have kids who don't look like they're old enough to be in school, calling themselves expert in trading, and all of a sudden make YouTube channels. It's where Instagram models who have never been in trading all of a sudden become expert traders. That's what a bull market is.
But what I'm saying, like in more of a technical standpoint, like what do you look for on the chart to give you an idea of a bull market if you're in a bull market?
Okay, I can use this. I can use this kind of analogy. Can you see this diagram? Yeah.
Yeah.
So for me, it's. I would like to see first of all this kind of diagonal kind of. Can you see this diagonal kind of sloping line here?
Yeah.
This has to kind of, in most coins, generally speaking, once that's breached, I'm a bit more confident it's gone from kind of bear market to more consolidation, really. And once this kind of like, obviously you've got the big moving averages like 50, 100, 200 crossovers, but once kind of these kind of big macro areas of kind of, kind of supply blocks, order blocks and all have been taken out, kind of, higher, that's kind of more shift towards kind of bear market, really.
Yeah. I've got my specific definition in my mind. So for me, what I look for is this. I look for, has the market broken the previous high, so the micro high, the last high it made? Has it got above that? Also, is the market above the 200-day moving average? And the moving averages change because sometimes they use exponential moving averages. But for Bitcoin, I think 200 days pretty much good enough. You could use 3 EMAs as well, the 21, 34, and 55. That's a good barometer on higher time frames, though. Anything lower than the weekly, no. It's going to be weekly or monthly. And then what you want to see is, you can use different indicators for this. You want to see, is the overall market volume increasing to the bulls? So are more buyers coming in overarchingly than the sellers? And you can actually see it on the MDX Oscillator 5. There actually is on the weekly, you can see the order flow. And it can show you, like, is there more buyers coming in? Is there more sellers coming in over a weekly time period? So for me, it's like this. You've got to be over some important moving averages. You've got to have at least broken the previous micro high, so the last high of the market. And then you need to see increasing buy volume. And then that, to me, would be we're in a bull market. The bulls are in control. Because if you're not above the previous high, the bears are still in control, haven't broken resistance. If you're not above the moving averages, the general average price of the market isn't rising. And if you haven't got the volume increasing, then you just don't have more buyers. So that would be my definition of it. But for a bull market, it can take me. I usually say it's a bull market a lot later than most people. A lot of people are like, oh, we're in a bull market, we went up once. It's like we're still above the previous high, or we're not above the 200-day, or the volume is increasing, because the volume is important, and there's a whole strategy built around just volume as well. You can use just by doing order books. Guys who don't even look at charts, they just look at order books. That's all they look at, and they just trade on the basis of that. So there is some interesting dynamics there. But these EMAs you've got are quite good. I don't know which ones you've got up right now, but
in COVID, during COVID 2020, you never really had to actually buy the exact lows. I never bothered really trying to time the lows. I kind of waited for the third and fourth higher highs. And once the kind of 50, all these bigs, there's 50, 100, and 200. I also use, the EMAs I use are generally 21, 55, the Fibonacci ones, right? Everyone, the Fibonacci ones?
Yeah.
And so once once kind of these kind of 50, 100, once, you get those kind of macro crossovers and kind of a fourth higher low, third higher low, I kind of went in more heavy, really. But my general strategy for kind of, I have this strategy, people, you do different things. Some people just buy 786. But this strategy of kind of back tested across 5 years. And it's kind of revision, but I always focus on units, lots. So Sand is something I bought at 3 cents in 2020. Well, Sand and Matic were my biggest winners. I got 100x
in
those.
Matic was one of my biggest winners as well. Yeah, I bought 4 cents Matic. That was that was my biggest altcoin win. I think ever, actually. I think there's one more. There's another one, actually, which did really well. I think Swarm Markets fucking did quite well. And that was about it.
So rather than doing Fibonacci, what I do is, I find a run-up of 80%, right? It's kind of objective, so let me just get this chart. Okay, so I find a run-up of 80%. So the recent run-up of Sand was 1.34. Then roughly I put an amount that I want to invest, so 8,000, right? So a recent run-up was 80%. Then I map out levels, so minus 20%, minus 30%, minus 40%, all the way down to minus 90%. And what I've learned in crypto is that you never want to be all in, and you never want to be all out. And the reality is you're not going to get all your positions filled in. I'm sure everyone else can relate to that. And so, for example, in this Sand situation, run up of 1.34. Okay, but rather than DCAing in equally, I incrementally DCA in 25% more on each dip. So, for example, if it goes down 20%, I'll put 5% of my total investment, 6.3%, 7.8 cents. So each time I'm lowering my average. So can you see in this column, average price per token, yeah? Can you see this column here?
Yeah, I think so, yeah.
So I'm kind of lowering my average. Then every time the price doubles from my average, I sell off 20%. So say if I get to the point of DCing down to minus 60%, and my average is 80 cents, and if it goes down to up to 1.6, I sell off 20%. If it goes to 2.4, I sell off another 20%. If it goes to 3.2, I sell off another 20%. So by the third part, by doing that 3 times, I've taken out my original investment. Then I look for the next run up of 80%, right? Then I use those profits to do the same thing and accumulate lots and lots of units. And so it's kind of it doesn't matter whether a market is going up or down. What I found with Fibonacci is that, for example, Sand, is that Fibonacci sometimes doesn't get you, it doesn't really anticipate for a minus 90% dip. Yes, you can get a minus, so where is Sand, for example? I'm just picking on Sand because I like Sand and Quant. They're my favorite altcoins. I just pick on those two things.
Yeah,
Sand,
I like Sand as well.
So in this situation, right? So let me find an example. So this was in January 2022. For example, up to here, right? This is a run up of 88%. Then I do a custom. This is my kind of like custom kind of fib. So some people just buy the 786, but the thing is, what I find is that it can always go a lot lower than 786. 786 is minus 36%, but it can always go down a lot lower, right? Yeah. So it's like a different kind of fib. So it's and it's a bit messy. It's a bit messy, but what I'm doing is put this coordinates down. One coordinate I put down to 0. So I have enough wiggle room to buy all the way down to 0. Minus 90%, so it's 48 cents. Realistically, it's not going to happen there, right? So I might fill an order up here, right? So I'm lowering my average. Then, I'm lowering it all the way down here. Okay, fine. These orders don't fill, but I've filled up this much. At this point, my average is like 0.8, right? Then it goes back up here. I sell off 20% because I've almost doubled my investment. It's a different way, really, that I found kind of backtested across 5 years. And for example,
it's a more of a scaling in. You're scaling in, scaling out. It's what institutional hedge funds will do, money management firms will do. Like they're always long and short. They're just scaling out of long, scaling out of short slowly, depending on where the market is.
Yeah, and so the thing is that like you're in a situation when you're never all in, you're never all out.
Sure. Yeah.
So I bought Ethereum for $200, but the thing is, imagine if you had 2 Ethereum, and it goes to 5,000, 10,000 isn't particularly life changing. I mean, it's a lot of money, obviously, but it's not like life changing, right? I always think in terms of trading, in terms of lifestyle, how is this going to change my lifestyle? But the thing is, if you accumulate a lot of units of Ethereum, that 2 Ethereum that you initially had from your own kind of hard-earned money from a job could be 20 Ethereum, right? And that's the thing, focus on units, the thing is I found quite useful.
Like, I don't even, I've been in crypto for so long now, I don't even really look at my USD valuation of my crypto anymore. I just look at what is everything totaled up to in Bitcoin. Because that's all I really care about. Like, I have my Bitcoin hodl stack, and if I'm accumulating Bitcoin, I'm just happy. And if Bitcoin goes down and I've got US dollars on the side, when I look at my portfolio, it just means my Bitcoin's going up. So I'm kind of like, whenever I hold US dollars, I'm basically short. That's how I kind of look at it. Because if I sell 200k worth of altcoins at 40k, which I did, I've still got cash, but it's okay, well, I don't really care about the 200k. I care more about the Bitcoin number. Because as the market drops, I have a calculation on my computer which shows me what it would be, that $200,000 in Bitcoin. So I know it's always going to go back into Bitcoin eventually, because that's where I want to park my money. I don't want dollars. At the moment, it's good to be in dollars, but it hasn't been for a long time, over decades. And the Great British Pound as well, obviously, is the biggest shitcoin ever known to creation. So we want to move out of these things and try and get into something like Bitcoin and gold as well. I do have a position in gold. I do think gold's really good as well. Everyone hates on gold, but I don't understand it. I feel like it's just that kind of moon boy emotional attachment to crypto. Is you saying you don't like gold, even though Bitcoin was sculpted from the mine of gold. So it doesn't really make sense. But yeah, say that I've been trading for maybe almost a decade. But the change. Say I speak to someone who's 45 years old, who's been trading for say 20 years more longer than me. From where they've come from to where we have today, it's mind blowing. It's insane. Most people would, to be a trader in the 80s, you would probably have to work for a firm. You'd have to go to a cubicle every morning, read the news, get some guy to fund your account, and trade for a firm every day. But now you can whip up your laptop, fund it with your credit card, trade any stock and share there is instantly. With maybe a billion people on some of these exchanges. Everyone's on these markets, and that's why I love crypto as well, is because there is no close, there is no open, and you can just dive onto an exchange and just trade basically Bitcoin sovereignty between hundreds of people. The derivatives is good, but if you're going on, I think the next big thing is DEXs. I do think DEXs are gonna. I don't think they're just gonna change crypto. I think they're gonna change the stock market as well, because I know an exchange called Bullish. I know the founders of the company, and they they've partnered up with the New York Stock Exchange, and they're actually building a whole liquidity. There are already deep pools and like dark pools in stock markets to create liquidity, but they're actually stock markets are going to be AMM soon. They're going to be using AMM software, and then you're going to have crypto exchanges and DEXs are going to lead the next step of what exchanges will be. And in the future, you're not going to see market makers and market movers. They're going to be completely irrelevant because the market,
like GMX.
Yeah, sure. And like, the thing about market makers and market movers, there's a big like grey area here. Market makers aren't bad people. Market makers are just doing their job. They create liquidity. They're trying to make the books filled up so people can trade on that specific asset. Then there are market movers. Market movers are slightly different. They're third-party people employed to push markets in a direction against the majority, so exchanges make money through market order fee. That's their game. But those two, so everyone blames market makers. There's nothing to do with them. They're just people doing their job. But then you've got the AMM software, the automated market maker pools, these liquidity pools, which eventually the market maker will become the people who participate in filling up the liquidity pool. So markets are going to get way more organic. They're going to get much more integrity, because you're not going to be relying on anything. There's not going to be as much relying on centralized people to make the market. And you don't need one or two or three or four people to create the market anymore. You actually just have anyone and everyone can create the market by filling up the liquidity pool, and that's going to that's going to be revolutionary for just markets in general. Yeah. Obviously, the technical analysis is just painting a picture over what the market's going to do, so you can put yourself in a position where you can have a higher probability of predicting or trading where the market's going to go. So the technical analysis isn't what moves the market. The technical analysis is a tool you use to draw shit on the screen and use tools and your strategy to put the probability in your court. Like,
it's like, because the analysis is there, perhaps it's like a self-perpetuating thing, a neckline or a level. There's so many people waiting for that level that it plays out. But it's interesting,
it's
what happens.
It's not really quantifiable in any way to know. So all I try and say is the market is going to do what it does. We're kind of like the fly on the back of a horse. If you're not an institution, or if you have a lot of money, like everyone's a market manipulator at some level. If you buy something, it goes up. It depends on how big the buy is. So everyone's manipulating the market every second. It's just a massive decentralized millions of transactions. Everyone's manipulating on their own individual stake. But if you think about the overall route a market's going to take through more like long-term cycles, there's no entity or person who can change that. And anyone who's screaming, it's because of the F2 pool they're dumping, or it's because of Tether were printing, that's why we went up. All of that's just bullshit. And even if it is true, there's no point even looking at it, because it's not quantifiable. You'll just waste your breath and energy on thinking about it when you could just be looking at the actual reality, which is the price.